Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs. Welcome to the latest episode of Advisor Upside, powered by ETF.com. I'm your host, Jeff Benjamin, and I'm talking today with Allan Roth, a veteran financial advisor and founder of Wealth Logic. The topic today is bonds, which Allan says should be as boring as possible. Okay, Allan, thanks for being here.
Thanks for having me, Jeff.
All right, it feels like these are unique times for fixed income, and I want you, Allan, as a veteran advisor, to sort of lay the foundation for what other financial advisors should be thinking about when it comes to bonds in this market.
Okay. I'd love to start with what a bond is and how I explain it to a client. Is that all right?
Yeah, sure.
Okay. So a bond is a loan. So when you buy something like a total bond fund, you're lending money to the government, to corporations. They're going to pay you principal and interest. So let's say, Jeff, you lend me $100 for 10 years at 5%, then I'm going to pay you $5 a year. On the 10th year, I'll pay you $5 interest plus your $100 principal back.
Mm-hmm.
Now, if your timing was not great and inflation reared its ugly head and suddenly 7% was the going rate, then you're getting $2 a year less than what the market says you should be getting. And the interest, along with the principal when it matures, is going to buy a whole lot less because inflation was higher. So holding that to maturity does not mitigate your interest rate risk. In fact, in that example, you would lose roughly 13%, which is what something like a Bloomberg Ag bond lost in 2022 when interest rates surged, which, by the way, was the worst year in the history of the bond market. And that's interest rate risk. Default risk is Allan Roth files for bankruptcy, and you likely get nothing back, and it doesn't matter what happened to interest rates. I'm old enough to remember, so goes General Motors, goes America, that buying a GM bond was every bit as safe as buying a government bond. Mm-hmm. By the way, the Bloomberg Ag, the largest bond funds follow this, used to be called the Lehman Brothers Aggregate Bond Index, and Lehman Brothers after 150 years in Wall Street. So even if you lent me that money in a laddered bond portfolio and a laddered loan portfolio, you still have interest rate risk. If you had lent it to me, by the way, at 3% plus inflation, then you would be much better protected. And we'll talk about tips perhaps in a little.
Yeah. Well, we're going to talk about ladders in a minute too, but first of all, let's kind of continue this down this path. With rates higher for longer, as we know, and that seems to be a cliche at this point, and as the Fed continues to try and fight inflation, what should financial advisors be talking to their clients about right now when it comes to bonds?
Well, bonds have an incredibly important role as part of the portfolio. They should always be there, and they should be boring. The top economists have called the interest rate direction correct on the 10-year Treasury bond roughly 35% of the time, less than a coin flip. The Fed controls the overnight rate, the Fed funds rate. That's all they control, and they influence the short-term rates. Markets control intermediate and long-term rates. Now, the reason why rates for bonds have gone up is inflation was a whole lot higher, and then real interest rates have shot up. And the reason why they shot up, the most brilliant answer I got was from the economist Larry Kotlikoff, reasons unknown. It's hard to predict interest rates. The Fed tells us what they're planning for the short-term overnight rate, but not so much for intermediate-term rates. Markets control that. There are lots of periods of time when the Fed raises rates and intermediate-term rates fall and long-term rates fall.
Why are higher interest rates such a problem for bond investors?
Well, they're a problem and an opportunity at the same time. When interest rates went up, our bonds and bond funds dropped in value, and that creates pain. But there's a lot of benefit from it that now instead of earning 1.6% or something like that on a total bond fund, we're earning a lot more now. And again, Treasury inflation protected securities, those rates have shot up from about minus 1.6 to, I look today, you can build a tips ladder at 2.35% plus inflation. So, we don't like it when our bonds go down, but again, 2022 was the worst year in the history of the bond market. The Vanguard Total Bond or the iShares Ag dropped about 13%. In Black Monday in 1987, the stock market dropped over 20% in one day. So put it in perspective. Bonds, are boring and should be boring.
Right. You made a couple of references to popular bond indexes or index ETFs, but can a case be made for owning individual bonds over bond funds in this market?
Yeah, in certain circumstances, absolutely. And first of all, the only bond that I would buy directly would be a bond that's backed by the U.S. government, like a treasury, let's say. Because again, corporate bonds have two problems. Default risk, again, that GM example, and there are many other examples, and they have huge bid-ask spreads, especially treasuries typically have very small bid-ask spreads. Corporates can have larger. Munis typically have between 1% and 2% bid-ask spreads that people don't ever see. And by the way, the largest bid-ask spread I've ever seen came from a client who bought a bond, with a 10.25% bid-ask spread. That client, by the way, happened to be a senior attorney with the Securities and Exchange Commission in Washington, D.C. He had no clue. But there are cases, for instance, let's say I sold my business. I'm going to owe $1 million in taxes April 15th of next year. So certainly buying something like a treasury that's going to mature just before then makes a lot of sense. Or buying, let's say, if I have a adjustable rate mortgage at a good rate, but it's going to reset in 5 years, then I buy a treasury bond or something like that, a treasury note that's going to mature in roughly 5 years. So I'm matching a liability that's going to incur in nominal dollars to a bond that's going to mature in nominal dollars. So yeah, those are cases where individual bonds can work better than bond funds. But buying an individual bond portfolio just creates a lot of complexity, bid-ask spreads. You can't diversify enough. There's reinvestment interest. So generally speaking, I'm a fan of bond funds over bonds. But again, treasuries are fine as long as it's by an entity that's licensed to print U.S. dollars.
Allan, could you compare and contrast the individual bond versus the bond fund if you're holding the bond to maturity? Because if you've got, let's say, a 10-year bond, okay, 10-year treasury, and you hold that thing for 10 years, and you hold a diversified bond ETF for the same period, that ETF is not holding any bonds to maturity, right? So how can they be comparable?
Well, some ETFs hold bonds to maturity. It happens to be that the definition of the Bloomberg Ag is 1 year or longer, so it sells them in 1 year. But again, holding the bond to maturity. If I build a ladder of bonds or bond ETFs in nominal terms, that mature in 1 year, 2 years, 3 years, 4 years, 5 years, keep going to 20, 25 years, et cetera. If inflation is much higher, I'm going to earn a whole lot less. If I built that portfolio, let's say in 2021 of individual bonds, I could kid myself that I'm going to get exactly what I paid for, but I'm earning a whole lot less than I could today. And the fact that inflation is a lot higher, I'm going to be able to buy a whole lot less. So it might hurt less, but there's a whole field of behavioral finance, which is kind of my specialty. A lot of things that feel really good, like it would have felt wonderful to sell stocks on, March 23rd of 2020 when COVID hit and stocks lost 35% in 33 days. But that was the wrong thing to do. It was the shortest bear market in history. So investing is about doing the economic right things and not about necessarily feeling good.
Yeah. I want to ask you one more thing about portfolio construction before we get into the laddering of bonds and bond ETFs. For the past few years, maybe longer, I've been hearing a lot of advisors and analysts and pundits talk about kind of the death of 60/40, the old model, the classic model. I know there's probably not a lot of people that actually have 60% stocks and 40% bonds, but it's still a benchmark that people look at. And the conversations over the past few years have been along the lines of we don't need that much fixed income anymore. What are
I,
your thoughts on that argument, and where are you with the people you advise?
well, on one hand, I don't believe in a 60/40 portfolio. I don't believe in simple rules like 100 minus
Hmm.
your age. It's your willingness and especially your need to take risk.
Hmm.
But there's a misconception that bonds have a negative correlation to stocks, and that is not true. They have a low positive and near zero correlation, which means that, on average, they're going to move in the same, 50% of the time they'll move in the same direction. The death of the so-called death of the 60/40 portfolio in 2022 wasn't the fact that bonds also went down when stocks went down. It's the fact that bonds had the worst year in the history of the bond market. Ed
Hmm.
McQuarrie from Santa Clara University is the most brilliant historian, financial historian I know, and his data shows that even going back to the early years of this country, it is the worst year in the history of the bond market. It was, but again, 13% in one year, that's the equivalent of the 88% stock during the Great Depression stock plunge.
Hmm.
So, on one hand, I don't believe in 60/40, and I never have. On the other hand, um, this whole belief that bonds have a negative correlation that's no longer there is baloney as well.
Okay, we kind of referenced bond ladders a few times in this conversation. Let's go into it. First of all, give us a kind of a Reader's Digest definition of what a bond ladder is.
Well, a typical bond ladder in nominal terms is buying bonds that are going to mature each year so that you have that income coming in,
Hmm.
the combination of the income from the portfolio and the maturity of the bond.
Hmm.
And the problem with a nominal bond ladder is you have no idea how much it's going to buy. Again, if I built that nominal bond ladder in 2020, 2021, the income that it's going to throw off and the cash flow is going to buy a whole lot less than when I bought it originally. And then if we have something like hyperinflation, the Fed is having a very hard time controlling inflation. And, we've never been at this point where we have so much debt and deficit. There's the potential that the government borrowing, it just keeps borrowing and borrowing, is going to crowd out corporate bonds and cause interest rates to surge.
Hmm.
So inflation scares the heck out of me right now. I'm not saying I'm 100% sure it's going to happen, but a nominal bond ladder does nothing to protect. In fact, nominal bond ladder, the longer the duration, the more inflation and interest rate risk you have, even though mentally you can say, I'm going to get back the dollars that I bargained for, unless there's some defaults, of course.
Well, if you're building a bond ladder today, yeah, I don't know if you would do it every year, but maybe you have a mature 5 year intervals. You got a 5 year treasury, 10 year, 20 year, or whatever, right? And
Same
as
thing,
they
a
mature,
20-year treasury,
all right,
if we have high inflation, is going to buy less and less and less. Sorry
right,
about
I
that.
know, but as it matures, you know on the day you buy it, if you hold it to maturity, what you're going to get. And then as that matures, you either spend it, depending on, and I'm talking about a person in retirement, hypothetical. You either spend it as income or you buy another ladder and maybe sell some of your equities for the income that you need at that point. That's what I'm talking about. I mean, so I agree you can get eaten up by inflation, but you can also, if you run these bond ladders the way they're designed, you do know when you buy it what you're going to get, right?
In nominal dollars.
Right.
I think
Obviously, yeah.
I just did a chart that I sent to somebody at the Wall Street Journal of here's what, $100,000. Let's say I have $100,000 that's going to mature in 20 years. Here's
Hmm.
how much it will buy, depending upon inflation. If inflation is 2-3% more than forecast per year with 20 years of compounding, it buys peanuts. It buys a
Hmm.
few $1,000s worth of stuff. So it is an illusion. Unless you're doing TIPS, Treasury Inflation Protected Securities, that's a different animal.
Right. And we're going to get to that in a second also. But just so for those of us, those in our audience that don't, when you say nominal, you're talking about actual dollars as opposed to inflation adjusted, right?
Correct. So if I get $100,000 in 20 years, if we had zero inflation, it would buy $100,000 worth of stuff. If we ended up with 5% inflation, it might only buy about, I haven't done the math, but let's just say $15,000 worth of stuff.
Right.
I can't live on $15,000 in today's dollars.
So does this mean that you're not in favor of ladders in any way, shape, or form unless they're Treasury inflation protected securities?
Yeah, unless you have a certain obligation that is due in nominal terms.
Hmm.
But I will say again, inflation scares me. So I've never been a believer in going long term, intermediate, and right now because of the inverted yield curve, and markets aren't stupid. The reason why we have this inverted yield curve is the market is saying that the Fed is going to eventually lower the short-term rate, and it's better locking in, let's say, a 5 or 10-year maturity at a lower rate than the current short term. In the long run, it will do better. Markets are not always right, but betting against the market is something that typically does not work.
Right. Let's talk about using some of the ETFs, the suites of ETFs that are designed for laddering. They have these things. I think bullet shares is one category.
Yeah, Invesco bullet shares,
Yeah,
I bonds for
BlackRock.
iShares,
Yeah,
yeah, which is not to be confused with the government I bonds.
right.
But yeah, so those are two vehicles to build bond ladders using ETFs. And because I'm not a fan of nominal bond ladders, I'm not a fan of those particular ETFs, with the exception of the recently introduced iShares iBond TIPS,
Hmm.
defined maturity TIPS, because again, that protects you. You know how much spending power that you're going to get with those
Right.
individual tips. Now, I wish they only go out 10 years. I wish they went out longer than 10 years, because think about it. If we have higher than forecast inflation, let's say
Hmm.
we forecast 2 and it ends up 5, then it's going to hurt a little bit next year. We're going to be able to buy less. But with 20 years of compounding of that higher interest, that's where you need the most protection.
Is it just this current cycle that you don't like these ETFs designed for laddering, or you just don't like them at all because they're in nominal terms?
They're in nominal terms. Inflation came for so long, but I was smart enough to know that I didn't know, just like I don't know today, what inflation is going to be over the next 10 years. Again, the topic, the 10-year treasury is correlated with inflation.
Hmm.
The top economists have called the direction, meaning up or down, on that 10-year T-bond 35% of the time, less than a coin flip. No one knows what inflation is going to be.
All right, I want to talk about the tips version of these ETFs, but I first want to talk about tips in general. Have tips worked in this inflationary cycle that we've been in for the past few years?
I would argue tips have, but the traditional tips funds, not so much. About 3 years ago, tips were yielding about inflation -1, inflation
Hmm.
minus 1.5. So you were guaranteed to lock in a loss of spending power. But what happened are real interest rates surged. As of today, I could build a 30-year tips ladder yielding 2.35% plus whatever inflation is. That, again, backed by the U.S. Treasury. If the U.S. Treasury defaults, we're all in trouble, and guaranteed to beat inflation.
Hmm.
So I'm a big proponent of building tips ladders right now, whereas I wasn't 3 years ago. Doesn't mean that I have a clue what the tips will be yielding at the end of this year or next year. But right
Hmm.
now, it's just a wonderful way to build, for instance, I could build a 4.65% safe spin rate for the next 30 years with a TIPS ladder. I built $1 million TIPS ladder for me and doing it with lots of clients as well.
What are the ETFs you're using? Let's give people some ticker symbols.
The ETF I'm using, the BlackRock iShares ETF, IBIA is going to mature this year.
Mm-hmm.
IBIB in 2 years. So
Mm-hmm.
CDEF all the way to J, which would be 10 years.
Okay.
So those are simple ways to do it. And TIPS do have a larger bid-ask spread than traditional treasuries. So there's an argument for simplicity to build it with these TIPS ladders. And by the way, this isn't in an ETF, but there's a new product coming out, or that just came out called LifeX. And those combined, that's in a mutual fund format, but it combines the TIPS with some longevity protection as well. But the fees are kind of high on that.
Have you seen an inflationary cycle like this, or one that can you think of one, Allan, that you can compare this current cycle to? I'm thinking you have to go back to the late 70s.
Oh gosh, I remember 1979, 1980 when I graduated college. And by the way, people say those were such wonderful times, and I say not so much, because you could earn, let's say, 12% on a CD or treasury, which meant that after taxes you got 8%, and inflation was running at close to 15%, then you lost 7% of your spending power. Yes, the fact that rates are much higher today than they were 3 years ago is more of a factor that 3 years ago, and for a long period of time, rates were incredibly low. We had a 40-year plus bull bond market from 1980, 1981, when rates started falling. So yeah, this is not new. This is not new.
It's not new, but it's also not fun, is it?
Not well. Like I said, do I like seeing that my bonds have gone down? No, but the fact that the yields are much higher, especially the real yields, the real inflation-adjusted yields, that's a wonderful thing. So again, short-term pain, long-term benefit.
I'm going to wrap up here with a question that is a kind of a tribute to one of my colleagues, Kent Tooney, here at ETF.com. He loves this this TLT. All right, it seems like everybody loves it. It's money just pours into this thing. It's at over $45 billion. The iShares 20+ year Treasury bond ETF, ticker TLT. Performance, 1 year trailing down more than 13%, year to date down more than 9%, 5-year average down 4%. Why do people keep pouring money into this thing?
I don't know.
I don't either.
You're going to get me in trouble with Kent, but no, it scares the heck out of me going long term, and I've never been a believer in going long term. I've actually, been between an intermediate term, and then I use a strategy of CDs that have easy early withdrawal penalties, so that when rates surge, you pay that small penalty to get out and don't take the loss of even an intermediate bond fund. But the only bond or bond fund that I would buy that is long term is one that has a defined maturity, inflation protected.
On that note, Allan, we're going to let you go. Hey, Allan, where can people find you? Where can they find your research and maybe follow you on social media?
Well, I write for ETF.com. I have for over a decade. And my website is daretobedull.com. And especially, investing should be dull with stock funds, but should really, really be dull with fixed income. That should be the most boring part of the portfolio.
All right. Well, it sounds like you've got the perfect name for your company and your website. Allan, thanks a lot for being here.
Thank you, Jeff. I enjoyed it.
Thanks for listening to Advisor Upside, and don't forget to check out ETF.com for all of our breaking news and analysis on everything you'll need to know about exchange-traded funds. Feel free to reach out to me directly at jeff.benjamin@etf.com and follow me on X. I'm at Benji Writer. Talk to you next time. Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs.